perspective and they are unrealistic. In reality, in practical world, there are brokerage costs, there are taxes, there are bankruptcy costs, and so on. So this was just made in order to simplify the theory. Later on, this theory was criticized a lot because of these assumptions. However, the theory is also a pioneer work and is very important because it provided clues about what is required to make capital structure relevant and hence to affect a firm's value. MM's work marked the beginning of modern capital structure research, and subsequent research has focused on relaxing the MM assumptions to develop a more robust and realistic theory. So MM has actually provided us the base that these are the factors that they had restricted are the exact factors that have an impact on the capital structure of the business. So they have provided us the list. Now, the later on theories, what they have done is they have relaxed it, let's say one assumption, and seen its impact on the capital structure. Then they have relaxed another assumption and then they have seen its impact on the capital structure. So it has provided a guideline for future research. So the MM theory, in conclusion, it says that the capital structure is irrelevant. Now we will move on to the next theory. So MM's original 1958 paper was criticized harshly, and they published a follow-up in 1963 that relaxed the assumption of no corporate taxes. So they themselves published another paper in 1963 in which they relaxed only one assumption, which was no corporate taxes. So now they're going to include corporate taxes in their model. And we will see what is the effect of corporate tax on the capital structure theory. They recognize that the tax code allows corporations to deduct interest payment as an expense, but dividend payments to stockholders are not deductible. You know that on interest there is no tax. First you pay interest and then the tax is applied. So interest has a tax shield in it. Whereas on dividends you have to pay tax. Dividends are not tax deductible. So the conclusion that he gave was that this differential treatment leads to an optimal capital structure of 100% debt based on the tax shield that interest provides, because they have still kept all of the other assumptions over there. So bankruptcy costs are not being considered. You need to understand this, that only one assumption has been relaxed. That's why they're saying that the conclusion was that a business should go for 100% debt because the tax shield is going to provide an advantage to the business. But having 100% debt in reality would mean a very high financial risk, right? The interest payments would be very high, due to which the business might go bankrupt if they are unable to pay the interest. But you need to understand that this assumption is currently not relaxed. So they are not considering bankruptcy costs, they're only considering the corporate taxes. Now, corporate taxes gives an advantage to interest, to debts. That's why they're recommending that 100% should be debt, and the financing should only focus on debt and there should be no equity at all. Now, moving ahead to the next paper. MM's 1963 work was modified several years later by Merton Miller when he brought in the effect of personal taxes. So in the previous paper, we have the impact of corporate taxes. Sorry about this. In the previous paper, we have the impact of corporate taxes. Now, in another paper, which was only done by Merton Miller, he is going to consider the impact of personal taxes. So you have two types of capital, debt and stock. Debt pays interest and the personal income rate for the interest is as high as 35%. Okay, so now you're looking from the investor's perspective, their personal income tax. This is based on the US book, so the rates might be applicable over there and not in Pakistan, but it will still give you an understanding of the theory. So the personal income rates on your interest payments. So if I am a bond holder, I have a bond, I will get interest payments. So the personal income tax rate in the US is as high as 35%. So 35% of the income will go, the interest income will go in the form of taxes. Now, if you look at stocks, the stock's return is in two forms, dividend and capital gains. Dividends are taxed, right? But capital gains are taxed at a maximum rate of 15%. So capital gains are not taxed that high. If you look at the interest payments are completely taxed 35%, whereas a capital gain has a maximum tax rate of 15%. So it's much lower. This tax can be deferred until the stock is sold and realized. Furthermore, capital gain tax can only be paid once the stock is sold. As long as the stock is not sold, the gain is not realized. जब तक आप stock को बेचोगे नहीं किसी और को, capital gain realize नहीं होता है. Right? Stock की price ऊपर जा रही है, that is a capital gain. लेकिन जब तक आप उस स्टॉक को किसी और को बेचोगे नहीं, आपका वो कैपिटल गेन रियलाइज नहीं होगा, आपको उसके पैसे नहीं मिलेंगे. सो कैपिटल गेन is taxed actually very much less. इंटरेस्ट के ऊपर तो टैक्स हर बार लगेगा जब जब इंटरेस्ट पे होगा, डिविडेंड्स के ऊपर भी टैक्स हमेशा लगेगा जब जब डिविडेंड पे होगा, लेकिन कैपिटल गेन पर टैक्स तभी लगेगा जब आप स्टॉक किसी और को सेल करोगे. सो अगर आप स्टॉक अपने पास ही रखते हो, इफ यू डू नॉट सेल इट, उसके ऊपर कैपिटल गेन टैक्स लगेगा ही नहीं. ओके. So on balance, returns on common stocks are taxed at lower effective rates than return on debt. So this is the conclusion that they gave. They said that if you consider the personal tax rate, actually the effective tax rate will be less on stocks compared to debt. Debt के ऊपर personal tax ज़्यादा होगा और common stock के ऊपर actually personal tax कम होगा. So there are 2 points that the deductibility of interest favors the use of debt financing. Right? Corporate tax की अगर आप treatment देखो तो corporate tax interest के ऊपर नहीं लगता और dividends के ऊपर लगता है. So the deductibility of interest favors the use of debt financing. Tax shield के basis के ऊपर अभी भी debt बेहतर है. But the more favorable tax treatment of income from stock favors the use of equity. Now you have two opposing views over here. अगर आप corporate tax को consider करोगे तो वो कह रहा है कि debt is better, right? Because interest के ऊपर tax नहीं लगता. And if you look at your common stocks, so common stocks के personal income tax के basis पे कॉमन स्टॉक इज बेटर बिकॉज कैपिटल गेन के ऊपर तो टैक्स ही नहीं लगता जब तक वो रियलाइज नहीं होता, वेरएज इंटरेस्ट की पेमेंट के ऊपर तो पूरे का पूरा टैक्स लग जाता है. So what was the conclusion? The conclusion was that it is difficult to specify the net effect of these two factors. However, most observers believe that interest deductibility has a stronger effect and hence that our tax system favors a corporate use of debt. So the conclusion is that based on the two opposing favorability, one is favoring debt, the corporate taxes is favoring debt, and the personal taxes is favoring stocks. It is difficult to say okay, what exactly will be the impact of these two factors on the corporate capital structure. But most of the researchers, they still say that the corporate tax rate has a higher favorability and it has a stronger effect. So still we will go with the tax shield one, that the tax shield and debt is more important than the personal tax advantage that is there in stocks. Now we are going to incorporate the effect of potential bankruptcy. So let me just revise before going on. This was the capital structure theory. It said there are no taxes. Then in the next one, sorry. So it said that there are no taxes, no bankruptcy costs, no brokerage costs, and so on. And based on this, I said that the capital structure is irrelevant. Then, firstly, we relaxed one of the assumption, which was the corporate tax assumption. Once we relaxed the corporate tax exemption, we said that the differential treatment leads to an optimal capital structure of 100% debt. Then we relaxed the personal taxes as well. However, we were unclear that what will be the impact of this on the capital structure, and we still said that the interest rate deductibility has a stronger effect. So we still favored the tax shield and interest more. Now we are going to relax the exemption of potential bankruptcy. So whenever there is loan, there are chances that interest will not be paid on time, which can lead to potential bankruptcy, which means that the business will end. MM's irrelevance results also depend on the assumption that firms don't go bankrupt and hence the bankruptcy costs are irrelevant. However, in practice, bankruptcy exists and it can be quite costly. So, in reality, every business, if you have taken on loan, you will have to pay a bankruptcy cost. And it can be very costly. Number one are the legal and accounting expenses itself. Two is hard time retaining customers, supplier, and employees. If you work for a business and you know that it is going to go bankrupt, the first thing you will want to do is you will want to switch your job because you will be scared that you might get fired or what will happen in the future. Similarly, your customers, your suppliers will also start to panic and will not do business with you. Third is that if your business might get liquidated. It means that your assets might be sold off in the market, and usually that gives you a lesser value than if the business continues to exist because assets are usually tailored to one business. And once you break off and you sell each asset individually apart, it gives you a lesser value. And even the threat of bankruptcy brings about this problem. So it's not only that once you become bankrupt, these problems will arise. Even the threat. So if a business is, let's say, 70% leveraged, it has 70% of its assets are financed through debt, and its earnings have become unstable. Like right now in the corona situation, a lot of businesses earnings have become unstable. They have no income. So even the threat of bankruptcy, that they might get bankrupt, will lead to these problems that we have just said. They might have to liquidate their assets. They might be selling off their assets in order to pay some of their interest. They might be firing employees in order to reduce their costs. Customers won't be buying their products, and they might be facing legal and accounting expenses that are too difficult for them to bear right now. So even the threat of bankruptcy can lead to a lot of problems for the business. The conclusion is that a firm whose earnings are relatively volatile faces a greater chance of bankruptcy and thus should use less debt than a more stable firm. We have discussed this before also when we were discussing operating leverage. Right? This is considered with our earlier point that firms with high operating leverage and thus greater business risk should limit their use of financial leverage. A बिजनेस whose earnings are volatile, यानी कि वो एक महीना कुछ कमा रहा है, दूसरे महीने कुछ और कमा रहा है, जिसमें स्टेबल ही नहीं है उसकी earnings, उसकी डिमांड बहुत ज़्यादा फ्लक्चुएट करती है, that business should not take on too much loan because interest की payment तो fixed है. Even when the economy goes into recession or and his business is not making any sales, he still has to pay those interest expenses, and if he is unable to do so, he will go bankrupt. Whereas if you compare it to a business जिसकी earnings बहुत ज़्यादा stable है, तो वो वाला जो business है जिसकी earning stable है, जैसे कि आपके grocery stores होते हैं, even if there is recession or anything, लोग grocery तो खरीदेंगे ही ना. So their sales is very much stable. They can take on actually a lot of loan because उनको कोई as such risk नहीं है. Their business risk is much less. Also, businesses that have high operating leverage. High operating leverage is with those businesses that have high fixed costs. So if your business is very capital intensive, and you already have very high fixed costs, then it is not recommended that you take on more loan as well, because आपको fixed cost वैसे ही pay करनी है. अगर sales कम हो गई तो आपको rent pay करना है, because you're so capital intensive, तो machinery की maintenance करनी है and so on. So you have already so many expenses कि आप interest का expense भी उसमें bear नहीं कर पाओगे. Whereas if your fixed costs are low, let's say you don't have to pay rent और आपके पास इतनी कोई machinery भी नहीं है जिसको आपने maintain करना है. अगर आपके fixed costs कम है, which means you have a low operating leverage, then your business risk is less. आपकी variable costs तो cover हो जाती हैं with your sales. Fixed costs को आपको cover करना होता है. So then you can easily take on more loan. Then we have the trade-off theory. The theory states that firms trade off the tax benefits of debt financing against problem caused by potential bankruptcy. The biggest benefit of using debt is the tax benefit. And the biggest problem of debt is the potential threat of bankruptcy. Now, a person who wants to use debt, he needs to balance off this risk and return and think, what is his optimal debt point. You can see that this graph is given to you, where on the vertical axis you have value of big B stock. So you just have value of a company stock on the vertical axis, and on the horizontal axis you have leverage. Leverage is measured from debt to asset ratio over here. Now if you look at the blue line, the blue line is value of stock if the firm uses no financial leverage. So if the firm uses no financial leverage at all, his value of stock will remain at the blue line. You can see that it is not increasing. So your value of the stock will remain over here at a constant. Value of the stock with zero debt is 20. But you do not want to make it at 20. You want it to improve. You want it to increase. So you will take on more debt. As you increase your debt, as you move from 0 to D1, you can see that the green line, let's look at the green line. You can see that your value of stock is increasing. And if you look at the red line, you can also see that your value of stock is also increasing according to that. But after the point D1, you can see that the green line starts to diminish. It starts to go down, whereas your red line keeps on increasing. Your red line is actually your result, incorporating the effects of corporation taxes. So said that you should go for 100% debt. So according to if you keep on taking, so look at the red line. So if you keep on taking loan, the value of your stock will keep on increasing. That's why they said that you should go for 100% debt structure, because your value of stock will keep on maximizing as you increase your debt, because they are including corporate taxes and they are ignoring bankruptcy related costs. Price of the stock if there were no bankruptcy related costs, but in reality there is always bankruptcy cost. You cannot have a business that has taken on loan but he has no bankruptcy expense, because they have to pay interest then, and if they are unable to pay interest they will go bankrupt and they will have to face then the bankruptcy costs that we discussed earlier. So now let's look at the green line. If you look at the green line, D1 is the threshold debt level where bankruptcy costs become material. So before this, because your debt level was so low, before D1, your debt level was so low that your value of stock was increasing as you took on more debt. But after D1, if you take on more debt, you will see that the bankruptcy costs have started to become important now. देखो D1 से पहले ये हो रहा है कि जो टैक्स का बेनिफिट है ना, वो टैक्स का बेनिफिट ज्यादा है और बैंक्रप्सी कॉस्ट बहुत कम है बिकॉज आपका डेट लेवल बहुत कम है. बट आफ्टर D1 बिकॉज आपने अब ज्यादा लोन ले लिया है, लेट्स से आपने अब 20% तक लोन ले लिया है. अब जब आपने 20% तक लोन ले लिया, आपकी इंटरेस्ट पेमेंट्स भी बड़ी हो जाएंगी, सो योर बैंक्रप्सी कॉस्ट, योर चांसेस ऑफ बैंक्रप्सी हैव इंक्रीज्ड एंड आल्सो योर बैंक्रप्सी कॉस्ट हैज इंक्रीज्ड. और वो मटेरियल होना अब शुरू हो गए. सो जो टैक्स बेनिफिट था ना, वो अब इतना ज्यादा आपको फायदा नहीं दे रहा क्योंकि वहां से दूसरी तरफ से बैंक्रप्सी का प्रेशर अब आपके ऊपर ज्यादा हो गया. Now if you look at D2, the point D2 is the highest point. Highest value of stock is at D2. And after this point, you can see that the value of stock has actually started to decrease. D2 के बाद से यानी कि आपने कुछ जरूरत से ज्यादा ही अब लोन ले लिया है और अब आपकी bankruptcy cost ज्यादा हो चुकी हुई है and your tax benefit has been overshadowed by the bankruptcy cost. Optimal capital structure is at D2, the point where your value of the stock price has been maximized. अगर आपने इससे ज्यादा अपना डेट लेवल बढ़ाया तो बैंक्रप्सी कॉस्ट आपकी बहुत ज्यादा हो जाएंगी और आपका टैक्स बेनिफिट कम हो जाएगा. सो योर वैल्यू ऑफ स्टॉक विल एक्चुअली स्टार्ट टू डिक्लाइन. अब इन्वेस्टर्स को होगा कि यार ये कंपनी का तो कुछ ज्यादा ही लोन है, सो वी शुड अवॉइड दिस कंपनी. एंड इफ यू गो बिफोर दिस, अगर आप इससे पहले वाले डेट लेवल D2 से पहले वाले डेट लेवल के ऊपर रहोगे, इन दैट केस यू हैव नॉट यूज्ड योर फुल पोटेंशियल, यानी कि अभी स्टॉक प्राइस और ज्यादा मैक्सिमाइज हो सकती थी. सो द ऑप्टिमल कैपिटल स्ट्रक्चर इज एट D2. I hope this is clear to everyone. So there is a trade-off and nobody knows if for every business this optimal capital structure point, this D2 is different, and it is very difficult for a business to be able to understand कि where is this D2 point. Okay, I'll do pecking order theory in the next video.